Hello, this is Dan Betzel, and I hope everyone is having a great week. I just wanted to get out a rather short but hopefully useful PowerPoint presentation about 2020, the year in review. I've been getting some questions lately about some fear about what's going to happen in 2021, and I thought a really good place to start would be to look at 2020 as a year in review. So we know that opportunity manifests around uncertainty. And let's just for a second, let's pretend we could go back to January 1st, 2020. January 1st, 2020. If you were able to get up that day and you had a very lucid dream and you were able to imagine what is going to happen between January 1st, 2020 and December 31st, 2020, what would this dream bring? So, if you were able to see most of what 2020 was to bring, what would you see? You would see impeachment, COVID 19, social unrests and protests, and a never ending election. And you would ask yourself, given what the world and the markets were going to face in 2020, maybe I should abandon my plan of a well diversified portfolio and just go to cash and sit it out. Actually, I know some people have done that. So, what I want to do in this presentation is I want to go through each of these four areas: impeachment, COVID 19, social unrest and protests, and the never ending election. And I want to show you, in retrospect, what happened during each of these rather very difficult political, social, and historical events. Let's begin first with the impeachment. Well, back in April 30th, I sent out a short little video about the impact of impeachment on your portfolio. And as a reminder, I included some historical data saying we've been through this before. And if we look at the S&P 500 Growth of Wealth Index from January 98 to April 99, during the time of the Russian financial crisis, Clinton confesses in testimony. The Starr report was released. The House impeaches Clinton, and the Senate acquits Clinton. We can see during this period. Yeah, yes, the markets responded temporarily. They went down. But we also see that from the time that the scandal first breaks in around January of 98 till the time the Senate acquits Clinton in 99, April 99, you can see on this graph what indeed had happened to the market, at least to the S&P 500. So, if we look at this index performance, we can see the three indexes: the Center for Research and Stock Pricing, the U.S. Total Market Index, Total Return Growth, the S&P 500, and you can see, what indeed, had happened, to those three different indexes. Okay, so we know that the portfolio was able to find a way forward through impeachment. Well, COVID 19, oh my gosh, I'm sitting here in my home. I basically, like majority of us, I've been in lockdown for months and months. And I remember when it first happened, when the World Health Organization issued the global health emergency back in January. I thought, well, this will be just a couple weeks, maybe 3 weeks, 4 weeks, and we'll get this behind us. Of course, it's still going on. I'm hopeful with the vaccination rollout and that things are going to turn the corner here soon. But as of today, when I'm making this, things still are very, very difficult. Whoever would have thought that we were going to have disruptions in our supply chain? We all probably can remember, the limitations on toilet paper and how it was almost impossible, to get high quality disinfect wipes. And then, of course, we have all of the social issues that were going on, and then school closures, and not only school closures, but the disruption that was to families and to many people. The businesses were closed and they've lost their jobs, and we can see the travel ban. I remember in 2008 when we had a travel ban, but that didn't last nearly as long, and it seemed like it was a very prudent reaction to what was going on at the time. But this travel restriction, of course, is much greater and going on for a much longer duration. So back then, back in February, I sent out some information about um, will the coronavirus make your portfolio sick? And we looked at some historical data. We looked, for example, SARS, the swine flu, the Ebola, and Zika, and we looked at what happened at the start of the crisis. And you can see on the bar graphs here that each of these previous outbreaks, the markets, of course, go down, and they swiftly rebounded. We can see 1 month after the peak and 3 months after the peak for each of them, for SARS, swine flu, Ebola, and Zika. Why is this? Well, your portfolio is built to withstand the epidemics. It has withstood it in the past, and there's a high degree of probability that it will withstand it in the future as well. So look here. This graph is just amazing to me, and I think during periods where you may feel panicky, we need to look at this graph, and we need to look that no matter what the social, political, or economic world is throwing at us, and it's thrown a lot of things at us in the past, we know that the market finds a way to continue to move forward. If we look back on March 10th of 2020, we can see that your plan and portfolio are prepared for times like these. And they're also prepared to recapture the rebounds that can happen in a blink of an eye. If you look at this, you can see that the bar graphs that are below the line, we've had some very difficult times in the past, and you can see though that what happens that after a period of downturn, and the market then roars back. And if you don't have your portfolio situated exactly properly, you won't be able to participate when it does turn. Yeah, so stay disciplined, stay the course, and stick to your plan. The Wall Street Journal wrote back in March 16th, the day coronavirus nearly broke the financial markets. And at that time, you may recall, I sent out some information about how to survive a bear attack, because that's what the market was doing, right? When the bear attacks, what do people want to do? They want to run, and sometimes that's not the best thing to do. This graph I find really interesting. It shows us that bear market losses are quickly recouped. And I think it's really interesting. If we look at this timeline here from 1906 to 2015, we can see that the average time it takes for a bear market to rebound is around 3 years, total 3 years. It's the average. Sometimes it's much less, and of course it has been longer. But nonetheless, we do know that the recovery time from past bear markets does occur, and it does happen rather quickly. Yeah, so bears happen. Bear markets happen. As a general rule, the market is up 75% of the time and down 25% of the time. The problem is it doesn't happen in a linear fashion. It's not up, 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 down, up, 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 down. It can sometimes be up, down, up, down, down. And it doesn't always, of course, fit into calendar years. But nevertheless, it's about a 75-25 trade. Remember, your portfolio is designed to withstand a bear attack and prepare for a rebound, assuming that you're in a well-diversified, evidence-based portfolio. But here's the trick. You have to let it. So, you may recall from my strategies for surviving a bear attack that I sent out to you that it's very important to be bear aware. Always have your portfolio risk in check. Make sure that you know how much risk is in your portfolio. Do you have a balanced portfolio? Do you have a conservative portfolio? Do you have a growth portfolio? If you don't know, please get in contact with me and I can easily walk you through that. Don't run. When you run from the bear, you lock in your losses. So, play dead. I read this in an article on how to survive a bear attack. Like a real, brown bear. Is play dead, sit tight, and the last defense is to fight back. Now, for this, I'm saying, how do we fight back? Well, we rebalance. We rebalance. We do that by selling high and buying low during periods of market volatility. Back in March 18th, I set out an email, and I had this graph that I think is really interesting, and it's not from me. It comes from another financial advisor, and I really like it. It shows the graph of what, unfortunately, a lot of people do. When the market's at an all-time high, they want in. For example, as Tesla breaks new and new records, people want more and more Tesla. So the greed causes them to buy in at the height of the market. When the market turns down, they have fear and they sell, and they repeat this process till they're broke. They buy high, sell low, buy high, sell low. We want to do the exact opposite. So, back in March 19th of 2020, we said during the recent turmoil, investors have paid the risk of investing. They should stick around for the reward. In other words, if you've designed a portfolio and you know the risk in the portfolio, and the portfolio experiences that risk, then what you need to do is to stay the course. You've now paid the price for being in that portfolio, and you should stay and reap the reward when it rebounds. Back in March 26, 2020, sent out an email about should the stock market be in quarantine. And I just, again, this is a visual I think is very, 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 very powerful. A history of market ups and downs. So the red, of course, that are below the are market downturns, and the blue is above the line. So if you just look at this, even visually, you can see that the majority of time the market is up, not down. But sometimes you don't feel like it because as you're climbing one of these mountains here, it goes up and down on the way up. And it's that up and down feeling coupled with periodic, actually real losses that provide a lot of anxiety for many investors. I certainly get it. I'm not saying that your feelings aren't understandable. I'm just saying don't let these feelings cause you to break out of your plan. So we've looked at impeachment and COVID-19. And what else did 2020 bring? Oh my gosh, social unrests and protests. If we look here, I mean, in my adult life anyway, I've never seen anything like it, right? And it's not just been the political violence, the demonstrations in the United States, and on a global level. And yeah, it's been just very, very disheartening on so many levels to see what's been going on both a domestic and international level. So I said back in June 11, 2020, that you're going to start seeing headlines about the economy's second quarter. And what you have to keep in mind is that the media is always lagging, right? So sometimes they're publishing articles about things that happened 2 and 3 months ago and really aren't comporting at all to what the reality, the current market reality is. And people sometimes get fooled by following this. So I said market volatility and scary economic news will come and go over your investing lifetime, but staying committed to a turbulent and a noble future is part of the discipline required for being a successful long-term investor. So, back on June 12th, 2020, there's always a lot of reasons to sell. But amid all of the volatility, here we are. And if you really stick to a plan of prudent investing and you do it for the long term, then you're not going to fall prey to all of the media's reasons why you should sell. And often when people do sell, what are they doing? They're selling at a very, very low point. So if we look at this graph, we've been through tough times before. 2003, 2008, it doesn't seem like it was that long ago, and then of course now in 2020. So, where do we go from here? I just find it really interesting. Back in August, I sent this out. It showed two headlines from March 9th, 2020 to August 18th, 2020. March, April, May, June, July, August, 5 months, a little over 5 months. On March 9th, it was the market bloodbath. Stocks crater, oil plunges, the IMF urges stimulus, Fed pumps more cash. And August 18th, the S&P 500 hits all-time high despite COVID-19 devastation. So here we see it, right? We see the markets the impeachment, COVID, social unrest, and COVID-19, which is still going on. I guess the impeachment's going on again too right now, the second impeachment. And you can see what the market has done. So we've talked about impeachment, COVID-19, social unrests, and the never-ending election. There was a lot of anxiety and stress up until the election. And then following the election, we had, it's like the election was never going to be over up until the inauguration. And what happened on the Capitol on January 6th, I think that was just maybe 2 weeks ago today, I think. I'm taping this on the, I'm not sure the exact date today. I think it's the 20, what is today? The 27th. So it was just 2 weeks ago. We had the storming on the Capitol. So we have the never-ending election, and I sent out right before, I think maybe it was end of October. I sent out a video about politics in your portfolio, and we talked about does it really matter who's in the White House as far as your portfolio is concerned? And we knew that there was this epic struggle that was still is dividing the country between these two men and these two parties and what they represent. Of the president or political party, we can see here, right? We see back to Hoover and Roosevelt and Truman and Eisenhower, Kennedy, Johnson, Nixon, Ford, Carter, Reagan, Clinton, Bush, Obama, and Trump. We can see that no matter who is in the White House, Republican or Democrat, we can see that the market finds a way forward. So it's just not worrying about how the election will affect your investments, because long term, we know that it doesn't affect them at all. So the case for staying calm and continuing to plan, even if everyone around you is reacting to fear, stay calm. So I'm giving you this historical review to help you remain steady as we move forward into 2021. We're fooling ourselves to think we aren't going to have more problems. Well, we know that COVID's still with us, the impeachment's with us. There'll be other things that we can't even imagine. So, index performance. Just take for a second and look back in January 20, all the way through October, November, and December of 20. This is the last year. This is what the markets have done, right? You can see impeachment, the COVID-19, social unrest, COVID-19, the never-ending election, social unrest, COVID-19, and I guess I could put impeachment in there again. So yes, 2020 has tested us mentally, physically, and emotionally. It's also tested our portfolios. And I do not take lightly the impact this past year has had on many. It's been very, very difficult in many, many ways. I've been very, very fortunate up to this point. My family, we're all healthy, and we've all been able to keep our jobs. And I know that's not the case for everyone. And I'm in no way not expressing my absolute empathy and understanding for the suffering that many, many people have gone through. So we also don't take lightly the job that you hired us to do. So if we look at the index, do you remember here it was, back in January, well, how high can this possibly go? And people were concerned about it can't keep going up. And then what happened? How low can it possibly go? And then, is there any way it can go higher? And then we're back to where we started, is how high can it possibly go? So what I'm trying to show is the cycle. And although it feels different, we can convince ourselves it's different this time. The facts, the evidence, the history shows us that if we have a well-disciplined portfolio and we stay disciplined, that our portfolio will find a way forward. So regardless of what was facing us at the start of 2020, it would have been impossible to anticipate the reactions and the actual outcomes that lie ahead. Now here we find ourselves waking up at the beginning of 2020. And I'm the first to say that no one knows for certain what 2021 will bring. I do know this, though, that opportunity manifests around uncertainty, and that the market finds a way forward. That your portfolio is built to sustain what's to come, whether it's more social unrest, God forbid, COVID mutations, which, of course, we all hope and pray that the current vaccine is going to be able to turn that around. Political political turmoil. We know stuff is going to come, right? But your portfolio is built to withstand and to sustain what's to come. So I encourage you to stay disciplined and to invest with evidence, as we talk about, not with emotion. So thank you very much. Thank you for listening. I hope it was a 20 some minutes well spent. If you have any questions or any concerns, please feel free to call me. You can call me on my cell phone, 614-648-0326. You can email me, Dan at BetzelWealthAdvisors.com. Probably the two best ways to get a hold of me, since I probably won't be seeing you around town for a while yet. So thank you so much, and I wish you and your family nothing but health and a sense of peace and calmness. Thank you.